Hi, I'm Samir Jain. Let's discuss systemic financial risk today. I've been reading about systemic risk and regulation and was struck that the equities and cash markets are regulated separately. And that to me sounds like both good and bad. It has the makings of both for and against supporting a systemic crisis. The securities market, unlike banks, have been less susceptible to contagious transmission of shock, and policy discussions should explicitly worry about the events where market integrity is tested. So I came to the conclusion that the design of the regulatory mechanism based only on individual bank risk could be suboptimal as in a multiple bank or universal bank context, and may well have the unintended effect of accentuating systemic risk. So optimal regulation should be collective in nature and should involve the joint failure of banks as well as their individual failure. So let me draw your attention to some important issues I came across in the course of my research. The first is protecting institutional investors. Institutional investors are large participants now in hedge funds and the proprietary money management firms. And I think they should be given additional rights to compel management to disclose more relevant data, value at risk, as well as more specific information on things that they may want, risk return, for example. And maybe government should encourage the development of rating agencies to examine and rate large hedge funds with high institutional investments. And it's particularly important that managers of investment funds firms give extensive supervision information and are closely monitored. And the SEC ought to bring these firms within the ambit of regulation. Why not? The second thing that I came across was strengthening takeover regulation. So minority shareholders have begun to play an increasing part. Regulation should be strengthened to protect minority shareholders and further protect exploitation by majority holders. A lack of minority shareholder protection, I think, severely restricts the ability of firms to raise capital. So legal changes are needed to strengthen protection and to strengthen the takeover code. In the US, it's not a big issue, but this issue is pretty bad in emerging markets. And with markets being increasingly integrated, I worry about this. The third thing that I came across is efficiency given the fast pace of innovation. So regulation needs to be strengthened to improve informational efficiency through probably better disclosure, price signaling mechanisms, something even as radical as the absolute ban on insider trading should be re-examined if there is a case that insider trading improves overall market efficiency. But of course, naturally, that must be balanced against its costs. I mean, someone benefiting at the expense of the uninformed reduces the willingness of uninformed investors to participate. We know that. Another point here is, given the increasing esoteric nature of some newly designed security instruments, any market manipulation will potentially cause significant misallocation of resources. And I'm going beyond derivatives here. And a lack of confidence in the transparency of the securities market will reduce the total amount of investment that is being undertaken. So specific steps that help to strengthen and improve market efficiency is absolutely critical to counter the effects of very radical financial innovation, because innovation is always ahead of regulation. fourth thing that I came across are risks posed by asset volatility. And we know that in order to reveal information, prices have to fluctuate. But price fluctuations themselves are costly to the extent that they impose a risk of uninsured changes in wealth on investors. So there is therefore a trade-off between allocated efficiency and risk sharing. So while regulation should not interfere in free market functioning, there is definitely a need to ensure that security markets are not out of sync with those for, say, indexed products and derivatives. And regulation for integrated management of linked instruments, I think, is lax, and it should be enhanced and enacted. Fifth is intra-bank risk. After the financial crisis, we've forgotten about that. So securities regulation has traditionally placed very limited emphasis on the prevention of systemic risk, since most of the regulation is towards the regulation of the individual firm itself. So I think additional regulation needs to be passed to ensure that securities firms continue to segregate customer funds from the firm's own funds. And there is a risk that a bank can fund in-house security businesses, and separate regulators would never know, because they would lack an integrated picture of the bank's consolidated position. So something that aims to create Chinese walls, I think, is a good thing, and it makes it easier when a security firm fails. It'll be easier to transfer the assets of that firm to another one. And securities firms have access to large value payment systems. So I think there is a need to beef up regulation of the clearing corporation too. The sixth thing that came pretty strong is internationalization. Most of these firms have become increasingly international, and they operate through a complex structure of affiliates in many countries with different bankruptcy regimes. The effect of international bankruptcy laws on the fate of these firms, I think, needs to be studied a bit more. And then the seventh issue that comes to mind is growth and size. A lot of these firms and banks have consolidated to form larger and larger entities, and partly this is because the formation of financial conglomerates has often involved M&A. So although it is possible that larger firms will be less likely to fail, the occurrence of failure is more likely to be associated with systemic risk, since the spillover effects on the rest of the financial system are bound to be greater. So new regulation should be enacted that treats the largest firms differently from the smaller ones. And of course, systems are only tested in times of market volatility. So short track records under normal conditions after the crisis should not generate too much confidence. And the best designed regulatory framework will fail to generate safety if it is not backed by effective enforcement. So I think there is a need to beef up enforcement too. All of these pieces, I realize, are parts of a larger composite mosaic. So bringing all of these together and thinking through these issues more carefully, I think, will be one safeguard against systemic risk. Thank you for listening in.